Welcome to ETF Edge, your go-to place for all things exchange-traded funds. I'm your host, Dominic Chu. Now, recent policy changes out of Washington, D.C. are shaking up the ETF space. Joining me now is Sal Gilbertie, the president and CEO and founder of Teucrium Trading, along with Eric Pan, the president and CEO of the ICI, or Investment Company Institute, one of the biggest advocacy groups for the mutual fund and ETF business. Gentlemen, thank you both for being here with us. I'd like to start with you, Sal, on the notion of cryptocurrencies. If we talk about the status of what we're, kind of looking at these days, we know that the fund business has now gotten much more into the ability for investors to park their money in cryptocurrencies, but in ETF format. You run one specific product tied to a specific cryptocurrency, and that's XRP. Maybe take us through just what was the impetus behind launching an XRP-based ETF for a guy who's basically run commodity-related funds for years now.
Well, we naturally do derivatives-based products. And so we have commodities-based funds. And then when the derivatives came in, for crypto, we filed immediately for a Bitcoin fund. And for a variety of reasons, including some regulatory changes that happened, we filed under 33 Act, and 40 Act came in the midst of that filing. And 33 Act takes much longer, it takes 270 days versus 75 days. And that really, we missed because of that. We missed our opportunity to be first in a crypto derivative space. And so I'm familiar with XRP, I'm a fan of XRP, and that was natural for us. You still can't own XRP in an ETF, the coin itself, the token itself. But XRP derivatives came out, and slightly before they came out, we figured out a way to package them, put them into a double exposure ETF, which I think is what people wanted. You've got a lot of traders, a lot of very aggressive people that want to do that. And so we put it into XXRP, which is double exposure for XRP.
Okay, so what exactly are the maybe investors or traders, I guess, in this way? Because for traders, they're the ones often looking for some of these inverse or levered type products. When you target an audience for the ETF market like you have, what exactly do you see as the profile for the people who traffic more intensely in a double XRP ETF?
Well, it's interesting because as an ETF issuer, we don't actually see who buys our things directly. We have to design a product that we think there's demand for. And we very much suspected and knew, I will say, that there was demand for XRP and demand for tradable XRP product where people could get aggressive. And this is an aggressive product, obviously, it's levered. It's not designed to be bought and held at all. It's designed to be traded each day. And people love it. People love it. A lot of interest has been in it. It has very high trading volume, and good flows have come in the last 4 months.
All right, Eric, this is an interesting development here with regard to just how the ETF business has evolved, specifically in the last maybe 10 years, and even more so with ETFs that track cryptocurrencies. From an advocacy group standpoint, your firm is one of the ones who advocates on behalf of many fund managers out there, lobbies on their behalf. What exactly have you seen with regard to the adoption rate of crypto-related fund products compared to other seemingly hot trends that have kind of been capitalized on in the ETF industry over the last couple of decades?
Well, it's definitely growing very quickly. First, we got to keep it in mind that ETFs in general, not only crypto ETFs, record inflows. Already this year, $600 billion in net inflows into ETFs, which is the highest it's ever been. So we're approaching record levels. So when you take crypto ETFs as a portion of that, from our perspective, demand is really strong. Investors are interested. Firms like Sal's are innovating quickly, and we have a new regulatory environment here in Washington that is really encouraging this type of innovation.
Eric, if I could follow up on that, it's also a regime, if you will, these days, regulatory and fund management and otherwise, that seems to be warming more to the idea of having crypto-related ETF-type products. Just how much are perhaps asset managers, ETF fund managers, really on board with the idea of crypto, or is it just a situation where you kind of put the product out there because there's such latent demand for it? Is it because that these fund managers really do believe in the product, or do you think it tilts more to the idea that it's give the people what they want, so to speak?
I think it's demand driven. Look, investment managers are there to serve the investors. And to the extent that investors are interested and curious in crypto products and other types of asset classes, there's going to be a response to meet that demand. A lot of our investment is still based upon fiduciaries and investment advisors. And I think that's really a personal conversation between individual investors and their advisors as to whether or not crypto is appropriate. But what we have seen is people are interested in crypto, and the industry has responded to that interest.
Sal, your product, you mentioned it is a levered product, so it seeks to gain 2 times the return of XRP on a daily basis, not necessarily for a prolonged period of time. We've told many stories, pitfall type stories about some traders or investors who use these products thinking that they're double X over a 2-month, 3-month, year-to-date, 1-year type period, and then getting burned. If you look at the way that many of the allocators have been treating some of these cryptocurrency type funds, they have been treating them as allocation instruments because some people just want to, say, own a piece of it. It's different than the profile that you kind of attach your product to as well. How do you, I guess, differentiate, or how would you tell the audience about how to use funds like yours versus ones who are straight up tracking, say, the price overall of a particular cryptocurrency?
Sure. I think allocators and people who want a steady exposure in their portfolio to crypto should do an unlevered fund. They should buy a fund that just holds the token and goes up and down with the token very, very smoothly in terms of no leverage whatsoever, as little static as possible. There's always fees and expenses and some slippage and static around execution, but in all funds. But on a double levered fund, those leverages are reset daily. That it is really meant to be held for 1 day and 1 day only. People need to understand that. We tell them, it's written in the prospectus, you have to really beat the drum to let people know if you just want exposure to a token, buy an unlevered fund. If you want to trade a token for price movement, then a levered fund could be an option for you. You have to really know what you're owning.
Anytime there are derivative instruments that underlie a particular ETF's products, you have to kind of treat them a little bit differently. As a person who's run, Sal, commodity-based ETFs and still does run commodity-based ETFs on agricultural products and things like that, just how different is running a crypto-related fund versus, say, a more traditional, I hate to use that term, but a traditional fund that tracks the movements of, say, an underlying product or futures product?
But in principle, they should be the same. In practice, because crypto's so new and the derivatives for crypto are so new, there's a lot more work involved on literally an hourly basis because you're finding liquidity, you're finding new players, you're testing the markets, you're testing the waters with these new derivative products that are out there. They're listed on exchange. They are well regulated. They're good products. That's why we use them. But the whole marketplace is getting used to it. So when you have a surprise success like the double XRP fund, XXRP, that causes you to scramble a lot more, finding trading partners, finding that liquidity, which we do. But it's a lot easier on established market like grains. Our corn fund, the futures have been around for 100 and something years on grains. It's a lot easier than a crypto future that's been around for weeks or months or maybe a year or two.
Eric, Sal makes a great point with regard to just how the product and its evolution has come. Technology has played a very big role in the speed at which people can adopt and roll out different types of products. I wonder, from an ICI perspective, for a group that is now representing many of the biggest asset managers out there and fund providers, maybe take us through some of the behind the scenes, if you will, for what the conversations are like from a regulatory, legal framework standpoint for advocating on behalf of fund managers and sponsors who want to put out crypto-related ETF products versus the ones who dabble in more traditional products like stocks, bonds, or even commodities. How different is the conversation that you're having with regulators and lawmakers about just what it takes to roll out a crypto product at scale?
So it's actually very similar. The conversation really isn't that different. And the basics are the same, which is we want there to be regulatory certainty. We're a regulated industry. Anytime the regulators are not providing certainty, it becomes legal risk, regulatory risk. We've got to mitigate that. And then the other thing is we want pro-innovation. We like the idea that through competition, firms, our members, can come up with new products, try them out, see if there's an interest in them. So that's really what we've been advocating for, both on Capitol Hill and with the SEC. And I'm very happy to report that our views get a lot of traction. We're very optimistic that Chairman Paul Atkins and his commissioners are thinking very thoughtfully about this issue, and we're engaging with them very closely.
It's interesting because it's fair to say that a group like yours does have some influence in crafting out what policy has looked like. Would you maybe handicap for us how you feel the current regulatory and legal framework regime has differed with regard to this administration and its treatment of the fund management business, especially around crypto, versus what you've seen in the past? And by extension, what exactly is the path forward in terms of trajectory look like when it comes to the adoption and rollout of more kind of, I wouldn't say frontier type products, but more forward-looking type products?
Well, I think first is I want to manage expectations because we're at the beginning of the journey in our conversations with the regulators about crypto. The CFTC does not yet have a permanent chairman. Paul Atkins has only been in office now for a few months. So we're at the beginning of the journey. But what I can say is they're very interested in hearing the views of groups like mine at the ICI. They want to talk to member firms. They want to understand what they're seeing in the marketplace. And this, to me, is a really positive step. I think at the prior SEC, there was a greater hesitation in terms of engaging with the industry. So again, conversations, a lot of data collection right now, a lot of trying to understand what's in the marketplace. But we're very much at the beginning of concrete proposals.
And Sal, if I could turn to you from a person who has to operate within this regulatory framework, how easy is it, so to speak, for you to get an idea for a product and roll it out and create a fund for it? Do you feel as though this is an environment that can kind of breed innovation within ETFs, or do you feel as though there are still things that ETF providers and the investors that deal with them have to understand more of before maybe these kind of newer type products are unveiled?
I think it's always the case that people don't need to understand more, but I think the regulatory environment in Washington has changed in that our job is the same and the steps that we take to list the fund are the same, but there's no animosity anymore. Now they look at what you submitted, they look at it with reasonable eyes. We're not feeling like they're antagonistic, that they're looking for a problem, that they're looking to actually go against whatever it is you're trying to do. It's a completely different environment in Washington right now. It's more friendly, it's more welcoming towards innovation, especially in crypto. And that's a welcome sign, and that's a relief for us.
From a provider standpoint, Sal, though, you do appreciate the idea that you use the word adversarial, antagonistic. There's probably a reason that some of the prior administrations did treat them with a bit of more of a skeptical eye, and that was to try to protect investors or traders that deal in these products. Do you feel as though the investing community has become savvy enough on a general consensus basis than they were, say, 10 or 20 years ago? Do you feel as though people understand the fund management business better, the products they put out, and then don't need as much hand-holding as they have in the past?
I think we're getting there. I think that people are becoming more savvy. I think savvy enough. I'm not sure anybody will ever be savvy enough. You've got to keep learning, got to keep on track. It's really important, especially the creativity of the products that are coming out. People need to understand what they're owning. The regulators are there. They're doing a great job. The U.S. markets are the safest markets in the world for a reason, because we have tight and very thorough regulations enforced by the regulators and overseen by the regulators. But there's a different environment now in that it's friendly, and that helps a lot. But I think investors always need to be learning. They're never sophisticated enough, in my opinion.
All right. Of course, I want to tilt the conversation to one other thing that's a huge focus, especially today, given the fact that the U.S. has now inked a very large, overarching trade deal with the European Union. Tariffs, of course, very much in focus this week with all the new deals being struck over the weekend. I wonder, Eric, if you might be able to shed a little light for us on just where you see some of the action developing within the mutual fund and ETF business specifically. We know there are themes tied to tariffs and trade policy. We talk about certain industries and sectors like pharmaceuticals, semiconductors, the auto business. We talk about geographies, emerging markets, developed markets. All of these types of instruments are out there. What exactly has come to light in your mind with regard to just how much more activity there is in thematic ETFs tied to trade policy as opposed to other investment trends that we've seen in the past?
So there's a lot of optimism in the markets. I think, again, going back to the certainty point, before we had trade deals, it was the question of what would be the hit caused by the tariffs. Now we have deals with the European Union, with Japan, conversations with China going on. I think people are very, very comfortable with the fact that whatever is the new normal, 15% or whatever the level is, the markets can now actually do long-term investing. And I think that's really positive. The fact that we have record highs is an indication that that the market is responding well. And I also want to say, because we focus a lot on the retail investors, there's still a lot of money that's sitting on the sidelines. If we look at money market funds, $7 trillion, half of that's retail money. So they're sitting on a lot of dry powder right now that could go into the market.
Now, if it does go into the market, I know that you're not an investment advisor. I'm not asking you to make a prediction here on this, Eric, but from somebody who has a bird's eye view, right? A very big kind of macro look at the fund management market overall. Where are you seeing some of the most activity build up with regard to how things might shape up for the second half of this year?
So I think I'm going to focus on the types of products because this is ETF Edge. We definitely want to highlight strong interest in active ETFs. That's one of the faster growing segments of our industry. And I think you see people want to take advantage of the benefits that ETFs provide, but also the active strategies that are new to ETFs. A lot of interest in that. And the fact that there is this interest is because of these market developments, people see opportunities.
All right, so active is a thing that we've heard many of our guests talk about before. It's just the growth relative to what we've seen in traditional passive index-related investments. Sal, I'll turn to you for one final question before I kind of close things out with Eric as well. From your perspective, what exactly is the thing or things that you are most looking towards to help you determine what the second half of the year looks like? You see commodities very clearly. You see what's going on with XRP. But I wonder what exactly would, from your management standpoint, be the things to watch out for to give us an idea of what this second half can look like?
Well, I think people need to make sure that liquidity stays stable, and it is. I think there's plenty of money, and as Eric said, a lot of money on the sidelines still. I think in terms of tariffs, we're getting some clarity, but in our business, especially with agriculture, what does the U.S. import? We import sugar, and so tariffs on sugar is a big deal for our sugar fund. And what do we export? For reciprocal tariffs, and that's very important because we've seen this before under Trump, where soybeans go down because China uses the U.S. as its last source. And so soybeans in the U.S. will go down temporarily, but there aren't enough soybeans in the whole world, so eventually China will run out of buying them from other people, primarily Brazil, and they'll have to buy again in the U.S. So I think people can look at, as these things play out, the grains like corn and soybeans that we export, they may see a little bit more depressed prices than you might ordinarily see during harvest time in October. And then you may see a rebound as people come in and buy. And if there's continued demand for sugar, and we are tariffing sugar, the sugar imports that are coming in, the U.S. does not produce enough of its own sugar. It must import. So there's going to be some effects there.
And of course, there's going to be ripple effects there with regard to the inflationary picture as well, given some of the aspects of the input costs fluctuating either up or down on that as well.
There could be products specifically, but tariffs aren't really inflationary because they're a tax. So products specifically, there could be some price rising.
All right, and Eric, I'll turn to you for our final question. With regard to the second half of the year, what exactly has got your interest peaked? What are you looking out the most for?
So I think being based here in Washington, very interested in whether or not the SEC allows ETF share classes to be introduced into the mutual fund product. Also, private assets. Big topic here. Should private markets be allowed in our retirement system? The use of ETFs to actually get exposure into private asset vehicles. That's an entire conversation that we need to have.
All right. Sal Gilbertie, Eric Pan, thank you both very much for joining us in this conversation. We could go on for ages, but again, I wish we had more time. We have, though, asked Eric to stick around for the ETF Edge podcast. You can catch that and all of our other content over at etfedge.cnbc.com. Thanks for watching. We'll see you next week.
Get the ABCs of ETFs with the ETF Edge newsletter. Your weekly update on the hottest trends, expert analysis, actionable ideas, and exclusive insight from top industry experts. Sign up now at cnbc.com/ETF Edge newsletter.